This is Nightly Business Report with Bill Griffith and Sue Herrera.
Ratcheting up, the U.S. will impose additional tariffs on Chinese imports. The president warns of more to come and stocks sell off.
Hazy outlook. Today's stock market decline could be a preview of what's to come, given August's bumpy history.
Shifting tastes. The fast food industry is betting that plant-based burgers turn into cash. Those stories and more tonight on Nightly Business Report for Thursday, August 1st.
And we do bid you a good evening, everybody, and welcome to August, that is. If today's trading session is an indication of how this month is going to go, investors had better buckle up. The day started with a pretty powerful rally. The Dow was up as much as 300 points, essentially gaining back what was lost yesterday when the Fed cut interest rates and then hinted that there might not be any more. But everything changed at midday when President Trump tweeted that he planned to impose another 10% in tariffs on $300 billion of Chinese goods, and the market reaction was immediate and sizable. The industrial average fell 280 points, 26,583. The NASDAQ was down 64. The S&P slipped by 26. And companies most vulnerable to higher tariffs were especially hit hard, including Caterpillar, Boeing, and Apple. Eamon Javers starts us out tonight from the White House.
President Trump spoke to reporters at the White House today after issuing that series of tweets suggesting he's going to be raising tariffs on Chinese products coming into the United States. He said he wasn't concerned at all about that stock market sell-off that we saw this afternoon in the wake of his announcement. He said he expected that, and he effectively here blames the stock market for not fully understanding what he's doing in terms of his tariff strategy. I asked the president on the South Lawn today, why 10%? Why not 25%? Why not 5%? Here's what he said.
I did more than anybody thought with the first $250 billion, and the 10% is for a short-term period, and then I can always do much more or I can do less, depending on what happens with respect to a deal. But I'm very happy the way it is right now.
So the president leaving himself a little flexibility there to raise or lower the tariff rates as he sees fit. That all puts a lot of pressure now on this meeting in Washington, D.C. in early September between the U.S. and Chinese sides. Negotiators will meet again face to face. Will this tariff increase put pressure on the Chinese side to come to a deal, or will it drive them farther away from the bargaining table? That's the big question heading into September. For Nightly Business Report, I'm Eamon Javers at the White House.
And the fear among investors is that additional tariffs could slow growth globally. That concern played out in the oil market today, which relies on demand from around the world. The price of domestic crude settled about 8% lower in today's session, its biggest decline since 2015. And that pressured shares of Exxon and Chevron as well.
The retail industry is one of the most exposed to China. That's why it has also been one of the most vocal about its opposition to tariffs on Chinese imports. And as you'll see here, the Retail Exchange Traded Fund, which is made up of more than 80 retail-related stocks, fell 3% today in response to the president's tweet. Courtney Reagan has more.
Well, many retailers have been working on diversifying supply chains outside of China for years and accelerating those plans when possible in recent months. China is still the #1 country where U.S. sold apparel and footwear is made. The National Retail Federation saying in part today, these additional tariffs will only threaten U.S. jobs and raise costs for American families on everyday goods. And the tariffs imposed over the past year haven't worked. Best Buy shares down more than 10% today in reaction. In May, then CEO Hubert Joly said it was, quote, premature to speculate on the impact of further tariffs, adding it's unclear whether List 4 will actually be implemented, what products would be included, at what rate, and when. Shoe seller Steve Madden shares lost more than 9%. Nearly all the products it sells in the U.S. are made in China. But even retailers and brands with lower exposure to Chinese manufacturing, like Tapestry, the owner of Coach and Kate Spade, and Capri Holdings, which owns Michael Kors and Jimmy Choo, sold off on the news. For Nightly Business Report, I'm Courtney Reagan.
Investors were not expecting to start August this way, and if history is any guide, it could become even trickier to navigate. Bob Pisani is at the New York Stock Exchange.
Talk about a tough setup for August. The market sold off today on a string of tweets from President Donald Trump signaling more tariffs on Chinese goods are coming next month. But even beyond today's move, history has not looked kindly on the month of August for stocks. It's the worst month for both the Dow and the S&P since 1987. And the S&P might be up 20% this year, or was, but earnings are flat. That's making stocks look very expensive right now. Trade tensions are obviously ratcheting up. There's very little clarity on the global growth story in general. And as Federal Reserve Chair Jay Powell made clear at his press conference yesterday, future rate cuts from the Fed are not a guarantee. If there's one thing that's made it easier for the bulls to stay bullish, it's lower interest rates. The markets are becoming more reliant on central banks to provide a backstop to slower global growth by cutting rates around the world. Still, plenty of bulls on Wall Street are arguing that the U.S. economic data still remains strong for the most part. Interest rates remain low, and despite Powell's reluctance to endorse a series of rate cuts yesterday, central banks around the world are certainly in easing mode. Still, the perceived benefits from the Fed cutting rates may have passed, and that could be a problem for stocks in August. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Let's turn to Brad McMillan now to talk more about today's market and his expectations for the month of August. He's Chief Investment Officer at Commonwealth Financial Network. Brad, good to see you again. Welcome back.
Thank you for having me, Bill.
You called today's market sell-off a sentiment reaction, not a fundamental one. What'd you mean?
Well, when you get this kind of a news item where the president is tweeting out, you can see a pullback. The market gets disappointed. Everybody sells first and thinks later. That's what we saw yesterday, only to see the market bounce back. And since the fundamentals are solid, that's probably going to happen again.
Indeed, because we do have a lot of headline risk still out there, do we not? Not only the trade situation, at least the debt issue is off the table, but we still have Brexit and we still have slowing global growth.
Slowing global growth is important, and so is Brexit potentially. But when you look at U.S. stocks, they track the U.S. economy. And the U.S. economy basically depends on consumer spending. We saw consumer confidence bounce back close to recent highs. We see job growth and wage growth continuing. The consumers are going to keep spending, and that's going to give us a cushion that should limit any damage from the headlines.
What do you think Chairman Powell thought of today's tweet? I mean, he made it clear yesterday during his news conference that trade is something that they're watching very carefully and they're learning as they go.
And I think looking at Chair Powell, he pointed out some of the risks, and they actually said explicitly that's why they cut rates. But the reason they're not saying they're going to cut rates more, and this is something that isn't really appreciated, is because they see the economy as basically solid. And we don't typically see sustained market drawdowns without a recession. And a recession still looks fairly distant.
All right, so if you're a longer-term investor, what do you do and where do you look for prices that are reasonably valued at this point?
I think you sit tight. I think the U.S., even though it is pricey by standards from maybe before 5 years ago, it's still fairly valued by the standards of the past 5 or 6 years. In fact, with interest rates low, you can argue that stocks can remain a good value. I still like U.S. stocks.
Brad McMillan with the Commonwealth Financial Network. Good to see you again, Brad. Thanks.
Thank you, Bill.
To the economy, manufacturing activity slipped in July to its lowest reading in 3 years. The Institute for Supply Management points to slowing global growth and those trade tensions. A separate report showed that construction spending fell more than 1% in June as investment in private construction dipped to its lowest level in 1.5 years. And the number of Americans filing applications for unemployment benefits rose last week, which was just about in line with estimates.
And in Washington, the Senate passed that 2-year budget deal that made it through the House last week. The legislation also lifts the debt ceiling and raises spending by $320 billion over current levels. It now goes to the president, and he is expected to sign it.
It is time to take a look at some of today's upgrades and downgrades. Morgan Stanley resumed coverage of IBM with an overweight rating. The analyst cites the benefits from IBM's acquisition of Red Hat. The price target is $170. The stock was up 1% to $150.32. RH, the retailer formerly known as Restoration Hardware, was upgraded to buy from underperform at Bank of America Merrill Lynch. The analyst cites price hikes, product momentum, and less risk to margins. The price target is $165. Despite the upgrade, though, the shares fell 2% to $136.08. And Corning was downgraded to neutral from positive at Susquehanna. The analyst cites execution missteps and a lack of confidence in the company's ability to deliver earnings growth. The price target is $30. The stock fell 3% to $29.74.
Still ahead, the television industry faces a new threat, and it's fighting back. Verizon's latest earnings report topped estimates, and the company said that it added more phone subscribers than expected during the quarter. Verizon pushed its deployment of the next generation 5G network, which the CEO says will be accessible to half the country by next year.
When we launched 1 or 2 markets to see that it's really working. Now we actually are deploying in all markets with all our vendors on infrastructure and with 4 different devices. So it is actually start working very well.
Stock fell very slightly in today's session.
General Motors posted a solid quarter, reporting better than expected earnings thanks to strong demand in North America. That helped offset its struggling international operations. Phil LeBeau takes a closer look at GM's bottom line.
GM's tale of 2 markets, the U.S. and China, shows the weakness in China is more than offset by America's insatiable appetite for trucks and SUVs.
What you're really starting to see is the earnings power of our truck franchise that is starting to show through in our results. And that's really driven by favorable customer reception to our Silverado and Sierra pickup trucks.
GM's new pickup trucks, often selling for close to $50,000 apiece, are in demand thanks to strong consumer confidence, low unemployment, and the fact more buyers are moving into a truck. In the first half of this year, Fiat Chrysler's Ram brand outsold Silverado, partially because of aggressive marketing by Fiat Chrysler. But GM says it will avoid an incentive war in order to move new versions of the Silverado.
Despite the pricing headwinds that might have been out in the market, you can see how we delivered and our market share is up. So what we need to do is to keep focusing on our plan and executing to that, and we will continue doing that.
Meanwhile, in China, where automakers are feeling the effect of an economy slowing down, GM's profits fell 60% last quarter. The company is optimistic business in China will stabilize thanks to a wave of new models. While GM's business in the U.S. is strong right now, it faces a number of potential challenges in the second half of 2019, including negotiations with the United Auto Workers. That contract ends in September, and many believe that for the first time in 2 decades, there is a decent chance we could see lengthy strikes at U.S. auto plants. Phil LeBeau, Nightly Business Report, Chicago.
The theme park business is strong, and today Universal announced plans to build a 4th park in Orlando, Florida, to be called Epic Universe. It is the single largest investment the company has ever made in its theme park division. The announcement occurs just as Disney is about to open its 2nd Star Wars theme park in Orlando. And just a reminder, NBC Universal is the parent company of CNBC, which produces this program.
But the entertainment industry is also dealing with a new headache, and it is pitting broadcast networks against a video streaming startup. Julia Borston has the details.
The big 4 media networks, CBS, ABC, NBC Universal, and Fox, are filing suit against a free video streaming service called LowCast for failing to pay retransmission fees or obtain permission to do so. LowCast is an internet-based service, which means you can watch local stations through a web browser or your mobile phone app, instead of having an antenna in your home. This comes 5 years after the Supreme Court shut down a similar service, Aereo, saying its TV streams violated copyright laws. Unlike Aereo, though, LowCast is a nonprofit, so founder David Goodfriend says copyright laws protect its service.
The provision of the Copyright Act that we're using was designed to make sure that a nonprofit could boost the availability of that over-the-air signal. That's all we do. The only thing that's different is we do it locally on the internet. By locally, I mean you have to be inside the local market in order to get our service.
But the media giants argue that LowCast is doing more than just that, saying it strips out Nielsen's ability to calculate ratings and that it requires users to provide an email address or log in with a Facebook account, saying, quote, that information is itself highly valuable to LowCast and is one of the many forms of commercial advantage that LowCast is securing for itself, while it serves the commercial purposes of the two pay TV players that have sustained LowCast and extended its reach. The broadcasters point to LowCast's ties to AT&T and Dish, which direct their subscribers to use the service during blackouts due to contract disputes with the broadcasters. AT&T recently disclosed a $500,000 donation to LowCast, and the suit alleges that founder Goodfriend, a former Dish executive and lobbyist, secured a loan from another former Dish executive. The suit claims that LowCast, quote, is a strategic play funded by and functioning for the benefit of decidedly commercial interests.
If AT&T or any other company makes a contribution to LowCast, that doesn't somehow undermine our nonprofit status. We are abiding by the IRS federal rules, by New York State rules for nonprofits. The notion that I, as a former Dish executive or lobbyist for Dish Network, somehow undermines our case, look, I have begged Dish Network to make contributions, and they always say no.
Now the courts will decide whether this startup nonprofit, which reportedly has 250,000 users, can provide local broadcast TV for free through the internet. For Nightly Business Report, I'm Julia Borston in Los Angeles.
Kellogg shares go snap, crackle, pop. And that's where we begin tonight's market focus with the cereal and snack food maker topping estimates thanks to an increase in North American sales of popular brands like Rice Krispies Treats, Pringles, and Pop-Tarts. Kellogg also reaffirmed its full-year outlook. Shares rose more than 9% today to 63.63. Clorox posted mixed results. They beat earnings expectations but fell short on revenue. The household products maker saw increased sales in its cleaning products division but issued weak full-year guidance due to challenges in its charcoal, bags, and wraps businesses. Shares fell nearly 4% to 156.14. Cigna's quarterly results were better than expected thanks to its health services unit. And even though the health insurer said that costs were higher than expected, it did raise its full-year forecast. Shares fell more than 1% to 167.56.
Dunkin' brand saw mixed results in sales in the U.S. with an increase at its Dunkin' stores, but then a decline at its Baskin & Robbins locations. The company raised its full-year earnings guidance. Dunkin' shares dropped 1.5% to $78.96. Strong comp sales at fast food restaurant chains Taco Bell, Pizza Hut, and KFC helped parent company Yum post better than expected results. Yum also got a lift from its delivery service relationship with Grubhub. Shares rose almost 4% to $116.94. Yeti topped estimates thanks to an increase in its drinkware, coolers, and equipment sales. The company also raised its full-year outlook, but a bigger than expected build in inventory weighed on the stock, and shares dropped nearly 7% to $32.34. And Archer Daniels Midland missed both earnings and revenue targets due to a rough winter in North America. The company also said it was hurt by the U.S. and China trade tensions as U.S. crop exports struggled. Still, shares were up a fraction to $41.15.
Beyond Meat came back to Wall Street for a second helping today. It issued new shares of stock, a so-called secondary offering priced at $160 a share. That's far above its initial IPO price of $25 a share just 2 months ago. Shares of the plant-based protein company fell 10% in today's session. Meanwhile, Beyond Meat's rival Impossible Foods and Burger King announced that the Impossible Whopper is going to be rolled out nationally beginning next week. It all shows just how these plant-based burgers are changing the fast food industry as we know it. Aditi Roy is in Redwood City for us tonight.
Introducing the Impossible Whopper, launching at more than 7,000 Burger King stores nationwide next week. It's Impossible Foods' largest partnership to date and a big win for the company in its race against competitor Beyond Meat over deals with restaurant chains.
I think we have the best product of any kind, the best burger of any kind on the market, but it's really for consumers to make that call.
Plant-based meat products from Impossible Foods and Beyond Meat are changing the fast food industry. The two companies are quickly landing partnerships with some of the biggest nationwide food chains, including Carl's Jr., Del Taco, White Castle, and Red Robin.
We think the big win here is bringing this to the masses at a compelling price.
Some industry watchers believe it's not a fad. Barclays says alternative meat can take a 10% bite out of the $140 billion global meat industry. And nearly a fifth of all Americans are trying to reduce their meat intake, according to NPD Group. Even iconic brand McDonald's might be eyeing plant-based meat.
But we're keeping a close eye on it and watch this space.
Still, there are skeptics, like the CEO of Chipotle, who recently said the chain would not include alternative proteins on its menu because they're too processed.
It's crazy because people think of processed foods as like, salty junk foods made by food manufacturers that really don't care that much about the health of consumers. We are incredibly conscientious about the health of our consumers.
Besides changing the restaurant industry, alternative proteins are also landing on grocery store shelves. Impossible Foods has announced it will soon start offering plant-based ground meat products at grocers and retailers starting next month. For Nightly Business Report, I'm Aditi Roy, Redwood City, California.
Coming up, the other space race, the one that powers our everyday lives. And here's a look at what to watch for tomorrow. We will find out how many jobs were created last month when the government releases the employment report for July. Exxon and Chevron report their earnings, and we'll also get quarterly results from Honda and Toyota. And that is what to watch for on Friday.
Meantime, mortgage rates are still hovering around three-year lows. According to Freddie Mac, the average rate on the 30-year fixed is now at 3.75%. That's down from 4.6% a year ago. Freddie Mac says that low mortgage rates, a tight labor market, and high consumer confidence should help support the housing market in the months ahead.
Amazon CEO Jeff Bezos sold nearly $2 billion worth of stock this week. That's according to new federal filings. Numerous reports say this could be his largest ever stock sale in dollar terms. Bezos previously has said that he would sell about $1 billion in stock each year to fund his space company called Blue Origin. Amazon did not comment on the filing.
News reports about Blue Origin and other space startups usually focus on the future of civilian space travel. But there's more to this growing industry than that. We've got high-tech rockets being built right now to deploy satellites which power much of the technology used in our everyday lives. Morgan Brennan has that story.
Virgin Orbit is the other space company owned by billionaire Sir Richard Branson, a startup focused on making and launching small rockets to put small satellites in orbit. At its California facility, Virgin Orbit is developing Launcher One, a 70-foot-long rocket that it hopes to send on its first test flight in the coming weeks.
Launcher One will go up on the wing on a 747 and put about 300 kilograms of payload into low Earth orbit, which will serve a whole bunch of customers from communications to Earth resources to science.
Unlike SpaceX, whose 230-foot-tall Falcon 9 rocket can boost up to 50,000 pounds to low Earth orbit, Launcher One is limited to payloads weighing 660 pounds or less. The company already touts a dozen contracts, including with NASA and the Defense Department. Launch price, $12 million. It's an emerging area of the space sector, but one expected to have significant implications.
We communicate using satellites, the information we get about our environment, and as we go forward about our businesses, about resources, we'll have better communication across mobile devices, aircraft, ships, the Internet of Things. All of these business ideas are percolating, and what's happened is the cost of satellites has come down substantially, and so now flocks of new business ideas are popping up because it no longer takes billions of dollars to develop satellites. It can be done at a fraction of that.
But Virgin Orbit is not without competition. Analysts estimate more than 100 companies are targeting this multi-billion-dollar small rocket market.
Good afternoon from Rocket Lab.
The leader is Rocket Lab, which has done 7 missions and with the backing of venture capital is now valued at more than $1 billion. And other players include Vector and Relativity Space, though established giants like Lockheed Martin have been making investments as well. For Virgin Orbit, whose sister company, Virgin Galactic, is set to become the first publicly traded space tourism company, the plan for now is to get to orbit.
We've been fortunate in having the strong backing of Virgin Group and Mubadala as our investors, and the personal guidance of Richard Branson. Goldman Sachs, Morgan Stanley both predict a space economy of over $1 trillion within the next 15, 20 years. So there's a lot of interest. A lot of people are coming and asking how can they participate.
For Nightly Business Report, I'm Morgan Brennan.
Here's another look at the day's final numbers from Wall Street. The Dow fell 280 points to 26,583. It had been up about 300 intraday. The Nasdaq was down 64 and the S&P 500 slipped 26. And that is Nightly Business Report tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening. See you tomorrow.